Hi, welcome to this tutorial on accounting basics. This tutorial is about a quick guide to accrual accounting. Very important concept in fundamental accounting. Okay, so this is my first recording in a number of weeks. I've moved house, moved cities, so it's taken me a while to set up in the new location. So thanks for coming back. Apologies if I'm a little rusty. I'm going to give this a go and see if I can get back in the groove. Secondly, I'm going to try and record this without too many pauses and stops and starts that would require lots of editing. Ideally, I'd like to appear in my videos, but I can't at the moment because I make a lot of mistakes, have a lot of edits, and I'd be jumping all around the screen with all the different edits. So today I'm going to practice, apart from being rusty, I'm also going to practice just running through this lesson straight through. Okay, so let's get on to actual content. Okay, so what are we going to cover? We're going to do a quick outline of accrual accounting, just be brief to the point. Then we're going to use examples to compare cash accounting versus accrual accounting and why the cash basis of accounting is often weaker. And then finally, we'll have a little bonus fact. So please hang around to the end. Little accounting bonus facts, which are very exciting. So please watch to the end. Okay, accrual accounting quick outline. Now, what is accrual accounting? Accrual accounting is a basis or method of accounting. It dictates how accountants record revenue and expenses. So when do you record it? How much do you record? That sort of thing. And it's in contrast to cash accounting, which is the other common basis of accounting. Now, accrual accounting is considered a generally accepted accounting principle, and thus is the most widely used accounting basis. It's often required. So when I talk about accrual accounting, it's not like, oh, well, this is some unique tool or technique that specialist accountants use. No, basically every accountant or every bookkeeper uses accrual accounting. This is what you learn at accounting school. We use accrual accounting because it better reflects the economic reality of business transactions. It allows better performance and position measurement from the financial statements. So why do we record these accounting numbers in the first place? Why do we have financial statements in the first place? It's so we can analyze businesses and make better decisions from them. So we use the financial statements to allow us to make better decisions, whether we're internal or external to the organization. So if we have bad information or bad data, that creates bad financial statements and we make poor decisions. So accrual accounting will better reflect the economic reality of the business we're analysing compared to other methods of accounting. And that's why we use accrual accounting, and we'll delve into that better economic reality in a second. Okay, so in short, accrual accounting says revenue is recorded when earned, and expenses are recorded when incurred, and they're matched to revenue if they're involved in generating revenue. So revenue is recorded perhaps when you think a sale occurs or when cash changes hands. It's actually when you carry out the performance obligation involved in the contract with your customer. When you carry out and earn the revenue is when you record it, irrespective of other situations that are going on. Expenses are recorded when incurred. When do you use that expense? Are you using that expense all throughout the month at a particular point in time? When you use the expense is when you incur it. That's when you record an expense. And if a cost or expense is used to generate revenue, then the revenue and the expense should be occurring at the same time. That's considered the matching principle. And the key idea is these events are not tied to when cash changes hands. Now that's probably error 1, 2, 3, 4, 5 for people who try to do their books themselves with no accounting training, or for elementary accounting students, is that cash doesn't dictate when revenue or expenses are recorded. And that's kind of counterintuitive. You think if someone gives you cash, then that's a sale. If you think you hand over cash, then that's an expense. But according to accrual accounting, that's not happens. And we'll explain why in a second. How do we account for the different timings between revenue being recorded or expenses being recorded and cash changing hands? What we do is we use asset and liabilities account to we use asset and liability accounts to account for these timing differences. So we may use an accounts receivable or an accounts payable account. So if we make a sale, but someone pays us a couple of months later, then we'll have credit revenue and then we debit our accounts receivable, and we have the asset account saying that someone's going to owe us that money in a couple of months, and that's how we account for the timing differences. Same with the payable. So if we incur an expense but have to pay for it in 30 days time, then we account for that difference by crediting the payables account, which is a liability account, and debiting the expense at that point in time. Okay, so that's a very quick outline to accrual accounting. I hope that helps. Now I'm going to compare it to cash accounting. So cash accounting, whether people call it cash accounting, it's probably the most common understanding or basis of accounting outside of accrual. So we're going to start with an example. We've got Barry's Consulting Limited, and he wants to buy company cars for their senior executives. And they're going to buy these company cars from Michelle Motors. So Barry's Consulting Limited buying company cars for their senior executives from Michelle Motors. We've got two entities here. Now Barry's Consulting will place an order for 5 cars on the 15th of April. The cars are delivered by Michelle Motors on the 10th of May. So about 25 days later. And Barry's Consulting will pay Michelle Motors on the 25th of June. So 45 days after the cars are delivered. So there are 3 different points in time there. The first point in time is when the contract takes place and the order. The second point of time is when there's some sort of performance and the risks and rewards of ownership are transferred between Michelle Motors to Barry's Consulting. Barry's Consulting gets a hold of the cars. Michelle Motors delivers on the performance of the contract. And then we've got the third point in time, and that's just when Barry's Consulting pays for the cars to Michelle's Motors. So 3 different points in time. So we're going to ask ourselves, when do we record revenue? We're going to look at it from Michelle Motors' point of view. So just ignore Barry Consulting for now. Let's worry about Michelle Motors. When does Michelle Motors record that revenue out of those 3 dates? Have a think about it for a second. Just hopefully, I'm really hoping you'll get the right answer straight away. When does Michelle Motors recognize the sale? So forget what you knew before this video. Have a think about what you heard in the past few minutes, and I'm hoping you can record. I'm hoping that you can remember or guesstimate when is the correct date out of those 3 dates when to record the revenue. Now, cash accounting, it will be the 25th of June. That was simple. That was the third date. That was when Barry's Consulting paid Michelle Motors for the cars. But according to accrual accounting, it will be the 10th of May. Now, that was the second date. So, why is the second date better than the first or the third date? So, the first date, when the contract is made, Michelle Motors shouldn't record revenue, because what happens if between that first date, I think it was the 15th of April, what happens if Michelle Motors goes out of business, or a flood wipes out all of her cars before she delivers them to Barry's Consulting? So she would have recorded revenue, but actually not done anything. So that wouldn't have been the best day to record the revenue, that first date. That third date is dependent on when Barry decides to pay. What if Barry decided to pay a month after that? Does that mean she doesn't record a sale for another month? Why would Michelle's sales be dictated to by Barry Consulting's payment frequency? So that's not the best time to record revenue, and although that will be the cash accounting. The best day to record revenue, according to accrual accounting, would be the 10th of May. Now that's when the performance of the contract was actually carried out. So the contract was, deliver me 5 cars. On the 10th of May, 5 cars were transferred from Michelle Motors to Barry's Consulting. And that's when Michelle Motors would record the revenue and recognize the sale. Alright, so accrual versus cash accounting. Why does this difference matter? So here are some of the problems with cash accounting. So as I mentioned before, what if customers take different time periods to pay? There could be one customer who never pays on time, or if all your customers paid around tax refund time. So how would you analyze the business's sales or expenses or profit in those situations? Like, do we just not make any sales if no one pays? Or do we make a whole bunch of sales at tax refund time, even though we may be making sales continuously throughout the year? It seems a bit odd. So business reality via the financial statements shouldn't be dependent on a customer's or your own frequency, payment frequency, or payment ability. That is, when you're analyzing financial statements, you're trying to make decisions about things you can control. That's why we have these financial statements, as I mentioned, so you can make decisions. So you want to be able to make decisions on things that you control. And if your business reality, according to the financial statement, is based on something outside of your control, like when someone decides they can pay or when someone can pay, then that is going to give you the best information to make decisions on. Here's another problem. What if some transactions take a long time to carry out and complete? For example, Boeing, and they build their Dreamliners over a number of years, or Airbus building their A380s. So in those contracts or those transactions, a airline might place an order in 1 year, and it may take a year or two before the plane is actually delivered, let alone when cash changes hands. Or what if some transactions involve an upfront payment, like a technology service contract? So if you are a technology consultant and you sign a contract to maintain or be the IT help desk for a private firm for 24 months, and you may get upfront payments for that. Again, it comes back to how you analyze the sale, expenses, and profit in those financial statements. Think about it for a second. So we've got the Boeing Dreamliner that takes 2 years to build, or we've got the upfront payment for the technology service contract. Can you imagine how whack those financial statements would look? So Boeing possibly made a sale for 5 Dreamliners in 2019, but wouldn't get paid for it until 2021. Boeing would operate for 2 or 3 years and have a completely blank set of financial statements, even though they've been in the factory building along. Even though they've been in the factory, building the planes and paying their staff and a whole bunch of other things. So business reality via the financial statements shouldn't be missing information just because no cash has changed hands. Nor should it include information just because cash has changed hands. That second one is regards to the technology contract. So if you sign that 24-month IT help desk contract, you may have this huge sale in January of 2019, and it looks like you're doing really well, but then you actually haven't done anything yet. How do you account for all of the costs and work and carrying out the tasks over the 24 months? And now, if you spaced out the revenue recognition over those 24 months, it would be a better reflection of you earning the income while you're doing the work. Okay, so do you see why another method or basis of accounting would better reflect economic reality and allow better analysis and decision making? And this is why we have accrual accounting. So I hope that helps. All right, here's our bonus fact. If you're still here, thank you very much for staying. This is accounting in ancient Mesopotamia. All right, so historians recognize the first accounting records were found in ancient Mesopotamia around 4000 BC, so about 6,000 years ago. So, that's a long time. That's a long history of accounting. Now, the ancient Mesopotamians were one of the first civilizations to record data for future use, and not just to have data or written words to convey information or communicate or for ceremonial or religious reasons. So, to record data, being the first civilization to record data for future use, was similar to our accounting data storage. That's why we have recording, so we can come back to our data, come back to our information, and make decisions based on prior data. Now, the Mesopotamians used tablets, so kind of like marble or rocks, I imagine. I'm sorry, I'm not a Indiana Jones archaeologist. I don't know what the tablets are made of. And they would have a pictographic script on them, so like pictures words. And some of these pictographic scripts included transaction data for markets and agriculture, and that's similar to transaction data. That's accounting data on these tablets, and then to organize these and store these tablets based on what size and shape they were and the pictographic content. So they had this elementary basis of an accounting record management. So they wouldn't just they'd have some sort of a level of organization where perhaps the 2 kilogram tablets would go in this pile, and that represented a certain type of transaction, and the 5 kilogram tablets would go in this pile, and that would represent a certain transaction. And then we'd have the square tablets go in another pile, and that meant transactions perhaps in the future. And then we had maybe a circle tablet pile, and that maybe represented transactions in the past. Now, that's all just made up. I'm not a historian, but from what I've researched and been told, they did have this level of organization which had the elements of an elementary accounting record management. Okay, that's it. I hope it helped. Best of success. There are your congratulatory fireworks. If you enjoyed the video, please click the subscribe button and ring the bell to get notifications. You can even set up notifications on your iPhone or Android phone. You can choose a video or a playlist from the right and watch another video now. Please share the video. I love sharing videos. I love my videos being shared. Or even just give me a thumbs up to say that you liked it. Finally, feel free to comment below if anything needs clarification or if you just want to say hello. Thanks very much.